Greetings, everybody. Welcome to Liberty Call. Today is Tuesday, October 8th, 2024. Hope you're having a fantastical day out there in the interwebs. It's kind of gloomy here in Colorado. It was clear skies and beautiful this morning, but got clouds coming in and it looks like we might get a little rain. So it's not supposed to be too cold this week. So anyways, hope you're having a great day out there. And looks like domestically the markets were in a decent mood, especially technology. But before we jump into things, if you out there in the interwebs, if you could do me a favor, give me some thumbs up, a like, a share, subscribe, a follow, send this over to a friend who might get something out of it. Hey, couldn't hurt. All right. And also press that notification bell. Let's get into today's numbers. Dow Jones was up 0.3%, 126 points, closed at 42,080. S&P 500 up 0.98%, 55 points, closed at 57.51. NASDAQ up 1.44%, 258 points, closed at 18,182. The VIX fell 5.34% today. It's at 2143. Canada down 0.13, Brazil down 0.35, and Mexico down 0.52. In Europe, I see a lot of red here. Germany was down 0.17, the UK down 1.36%, France down 0.72, Netherlands down 0.26, Spain up 0.15, Italy down 0.24, Switzerland up 0.04, and Portugal down 0.37. All right, Russian exchanges, MOEX down 0.29, RTSI down 0.34. And the overnights, let's see here, the Nikkei was down 1.26, Australia down 0.35%, New Zealand down 1.49%. In China, the Shanghai was up 4.59%. The Shenzhen Component up 9.17%. China A50 up 4.08. DJ Shanghai up 5.19. Hang Seng was down 9.41. And the Taiwan weighted has not been open since the 7th when it was up 1.79%. All right. So kind of a weird day there. All righty. Let's see here. Let's hop into the market recap. Stocks flat as China slumps. U.S. yields edge up on Fed expectations. So let's see what's going on in the world. Global stocks remained largely flat on Tuesday as investors awaited upcoming U.S. inflation data and corporate earnings while reacting to disappointing stimulus details from China. In the U.S., the S&P 500 rebounded from Monday's losses, driven by nearly 2% increase in tech stocks. Last week's solid U.S. jobs report had heightened concerns about potential interest rate cuts, adding to unease over escalating Mideast tensions. Investors are particularly focused on Thursday's Consumer Price Index, the CPI, release and the start of the U.S. earnings season with major banks. European markets declined, impacted by a lack of concrete measures in China's fiscal stimulus announcement, which hit sectors relying on China's economy, including mining and luxury goods. The MSCI World Index was virtually unchanged, while the Stoxx 600 fell by 0.55%. Chinese markets saw mixed results. Hong Kong's Hang Seng Index dropped 9.4%, marking its worst performance since 2008 amid disappointment over China's vague economic stimulus. Meanwhile, the Shanghai Composite and CSI 300 indices recorded gains, reversing some of the losses from earlier in the day. In U.S. Treasuries, yields edged up slightly following strong jobs data ahead of the CPI report. The likelihood of a 25 basis point rate cut by the Federal Reserve in November remains high at 87.3%. Oil prices fell after recent gains, with U.S. crude and Brent down 4% as concerns over supply disruptions in the Middle East eased. Meanwhile, the dollar strengthened slightly against major currencies, reflecting ongoing geopolitical risks and market adjustments. All right, so that's the market for today. I mean, we just looked at the Chinese markets. Some were way up, some were way down. It's kind of back and forth. All righty, let's dive into some data. August international trade comes to us from First Trust. Mr. Strider Elas put this together. All right, in August, the U.S. trade deficit in goods and services decreased to $70.4 billion, driven by a rise in exports and a drop in imports. However, the focusing on total trade volume, which includes both imports and exports, reveals that cross-border business and consumer activity increased by $2.1 billion. Total trade is up 6.5% from a year earlier, with exports rising 5.1% and imports increasing 7.6%. The boost in imports partially reflects businesses' efforts to secure supplies ahead of the dock workers' strike, which affected East and Gulf Coast ports and concluded in October, well, just a few days ago. and it's technically not over. They just postponed it until, what was it, like the second or third week of January between, I guess, J6 and the inauguration. We'll see what happens then. But so, I mean, I imagine they'll probably come to a deal. But anyways, all right. The pattern of U.S. trade has also shifted significantly, with Chinese exports to the U.S. up just 1.3% year to date, compared to 24.3%. Compared to a 24.3% decline versus the same period in 2022. Mexico is now the leading exporter to the U.S., followed closely by Canada. Global supply chain pressures have lessened considerably, as evidenced by the New York Fed's Global Supply Chain Pressure Index, which has decreased substantially since 2 years ago. Additionally, U.S. petroleum exports continue to exceed imports, marking the 27th straight month as a net exporter in the sector. All right, good stuff. Alrighty, next up, this article comes from Zero Hedge. Something went totally nuts at the Bureau of Labor Statistics, but labor market indicators still strongly suggests a recession. This was put together by Mike Shedlock via mishtalk.com. All right, the McKelvey PMES recession indicator, which combines unemployment and job vacancy data, weakened slightly in September, but still strongly signals a recession. This indicator, based on economist Edward McKelvey's method, flags a recession when the 3-month average employment rate exceeds its 12-month low by at least 0.3 percentage points. However, Claudia Sahm later modified this threshold to 0.5 points due to false positives. Yeah, it's called the Sahm rule. You might see that in financial articles out there. We've crossed that. What's funny is that Claudia Sahm is she's not a conservative. So when it started showing, when her Sahm rule started to show that we're headed towards recession, she's like, well, maybe she's trying to point out why there's flaws in her matrix. And it's like, well, just because you hate Trump doesn't mean, you're going to do everything in your power to, kind of like 4 years ago where, all the spending and everything with COVID, made people do silly things. So, all right, let's dive back in. To refine the McKelvey model, economist Pascal, I'm going to mess this up, Michel Lat and Emmanuel Sainz created the PMES indicator, which integrates job vacancy rates with unemployment data, using the minimum value of the two indicators for more accuracy. Job vacancies drop in recessions as unemployment rises, and by combining these metrics, the PMES model aims to reduce false positives. In recent analysis, the McKelvey indicator had a reading of 0.48, suggesting a 50% recession probability. Combining it with the PMES data, which considers vacancy rates, improves its accuracy. In September, the Bureau of Labor Statistics reported an unexpected 254,000 job increase, but with questionable reliability, as it is also noted a surprising rise in government jobs. While the McKelvey PMES model still signals a recession, concerns over data accuracy remain, especially regarding unusual job growth in the latest report. Yeah, not that anyone in government would ever lie about the number of jobs or the economy so that they could keep their job and keep the administration in place. So, I mean, granted, I don't like either side. Red, blue, they're both bad in my opinion. So I'm more of a black and gold kind of guy, anarchist kind of person. All right, last up, another article comes to us via the Mises Institute. This one's on Zero Hedge. Can America survive global de-dollarization? This was written by Daniel Kowalski via the Mises Institute. So let's see what Daniel has to say here. All right, Mr. Kowalski argues that U.S. policymakers have disregarded fiscal prudence, eroding the dollar status as the world's reserve currency. Well, we beat that horse to death over the years. The dollar, which gained dominance after World War II and the establishment of the Bretton Woods system, has been vital to global trade. Well, when you destroy the the economical engine that was Germany during the from the 30s and 40s, when you carpet bomb the entire country, and France is, obliterated. Yeah. I mean, America, and then the Japs were, a mess. The U.S. was really the only, industrial giant that was still, had all its factories in place. So it kind of made sense. Makes you wonder, did we really join the war to save everybody, or did we really do it for economic dominance over the world? So You can speculate at your leisure. All right. However, American policies of inflation and sanctions have undermined confidence in the dollar, prompting countries to seek alternatives. The abandonment of the gold standard in 1971 enabled unchecked money printing, contributing to today's $35 trillion debt and runaway inflation. Modern monetary theory, or MMT as people call it, fueled reckless spending, assuming that the U.S. could print money without consequence. Kowalski points out that many states, especially California, carry significant debt burdens. A federal bailout for high debt states would create resentment among states with balanced budgets, threatening national unity. Well, first of all, it's not a nation, it's a republic. So we are not one. It's not the United States, it is the United States. Like when we, beat England in the First War or in the Revolutionary War, they said the many states, not the United States. Anyways, there's your history lesson, folks. Where was I? Additionally, the political divide between red and blue states has intensified as businesses and residents flee states with high taxes and restrictive policies for states with friendlier business climates. The outmigration risks further reducing tax revenues in these states. Should the dollar lose its reserve status, the U.S. would face severe economic strain without rising prices and a decreased ability to import goods. Kowalski warns that resolving these issues would require difficult policy decisions and leaders willing to address long-term fiscal imbalances rather than postponing them for future generations. Nah, it's just much easier to push it off to my granddaughter. Let her deal with this problem when she's, 30 and, 28 years. So anyways, all right. Well, that's everything that I had for today. I don't see anything else on my screen. If anyone needs anything from me, please go to DSAFinancialGroup.com. That's where you can go get all your financial planning needs addressed. Give me a buzz. I'd be happy to get you back on the right track. All right. Well, I hope everyone has a fantastical afternoon. Me and my main man, Jake, are going to go play some ball time and probably do some other stuff later on today. But that's it for the Liberty Call. Hope everyone has a great evening. I'll talk to you next time. Adios.